Welcome to the world of Mark's Money Mind, coming to you this week from Longmont, Colorado. I'm your host, Mark Troutman. This educational, personal finance show combines money lessons, timely topics, personal stories, and community wisdom to help listeners and viewers master their finances to enjoy a stress-free life of financial freedom. Sorry for the brief hiatus from publishing for a while. I've been super busy with moving into and settling into my new home here in Longmont. Also just got back from the annual FinTalks Cruise hosted by Amberly Grant. We had over 100 people on board this year. Next year, there will actually be 2 FinTalks Cruises, one of which will be to Alaska. I'll put the link to that in the show notes if you're interested in joining us next year. I've been thinking about this topic for a while since the markets have been on a tear for a number of years without any real significant setbacks. However, as you may have noticed, this may be changing. There's been increased volatility in the market, heightened uncertainty with the new administration and the policies being implemented. So, are we headed for a bear market? I have no idea. So, what do you do amidst all this uncertainty? Well, I fielded a number of calls and had a number of conversations recently with people asking me, should they adjust their investment portfolio in reaction to what's happening right now? Obviously, there's increased uncertainty from the people that I've spoken to. And my answer usually is, what does your investment policy say? Well, what is an investment policy statement, you ask? And that's what I want to discuss today. The Bogleheads website at bogleheads.org has a great article that addresses this topic in great detail. I want to walk you through this a bit and then talk about what my personal investment policy statement looks like as well. The link to this investment policy statement by the Bogleheads is in the show notes, so feel free to click on that and follow along. I'm going to read a couple of things from it. They state an investment policy statement is a statement that defines your general investment goals and objectives. It describes the strategies you will use to meet these objectives and contains specific information on the subjects such as asset allocation, risk tolerance, and liquidity requirements. And they talk about the benefits of using a investment policy statement. They continue. Every investment could potentially benefit from having an investment policy statement. It provides the foundation for all your future investment decisions. It serves as a guidepost, identifies goals, and creates a systematic review process. The investment policy statement aims to keep you focused on your objectives during short-term swings in the market and gives you a baseline from which to monitor investment performance of your overall portfolio, as well as the performance of individual fund, they say managers, but I would say funds, especially if you're using index funds, for example. It continues. A properly constructed investment policy statement supports a well-conceived long-term investment discipline rather than one that is based on false overconfidence or panic in reaction to short-term fluctuations. Let's stop there for a moment. The market has been going up for a number of years. In fact, if you look back, the market has really just been on a continual progression from the 2008-9 bear market, really. Yes, there was the COVID dip, but that was very short and temporary. So the market has really just kind of been going up, up, up. And in the last 2 calendar years, it's actually returned more than 20% per year. That's the S&P 500, using that as a benchmark. And I think a lot of people get kind of complacent when the market just keeps going up and up and up. And they forget that market declines do happen. Now, here we are at the beginning of 2025 in March right now, and the market certainly has had a setback, not significant, but certainly has come off of its highs. If you look at valuations in the market, you've seen a lot of articles potentially about that. The market is not inexpensive right now. I also like to read the annual report from Berkshire Hathaway, whose CEO is Warren Buffett. And it's very interesting that Berkshire Hathaway has amassed quite a war chest of cash. One of Buffett's famous sayings is, be greedy when others are fearful and be fearful when others are greedy. I was kind of interested to see, would he discuss the cash balance or cash situation that is currently at Berkshire, basically about a third of the market cap or the third of the value of the company is currently in short-term treasuries. That's kind of a statement on its own. He didn't say a lot in the letter, and I will also link to the letter in the show notes, but he did allude to the fact that equities are the place to be for the long term for most investors. But without saying it, I think he's not finding a lot of opportunities. Now, of course, Berkshire Hathaway is quite different, and they have to put a lot of money to work to make any kind of significant material difference at the company because of the size of it. But without saying anything, it's saying something. Now, let's get back to the investment policy statement. The Bogleheads article also talks about the drawbacks of not using an investment policy statement. And I think this is important. Someone without a written policy often bases decisions on day to day events, which regularly leads to chasing short term performance that may hinder them in reaching long term goals. Having a policy encourages you to maintain focus on the long term nature of investing, especially during turbulent or exuberant times. And that's where we are to some degree today. A little bit of turbulence. What does your investment policy statement say? Try to remove emotions from your thinking so that you're not being reactionary when things don't go to plan or don't follow the kind of steady progression we've seen over the past number of years. So, I will highlight some of the things that the Bogleheads talk about in having a written investment policy statement. They talk about it in various sections. The first sections is financial account information, such as where are your assets located, what type of accounts, are they tax advantaged accounts, are they taxable accounts, and how much you will be contributing to these accounts. So if you're in the accumulation stage, you may have a section of the investment policy statement that says, I am going to be contributing X per paycheck, per month, what have you. We talked about this in the one-page financial plan. That's where I put that information. I don't necessarily have it in my investment policy statement. I have it in that separate one-page financial plan that we talked about in the last episode. Then the next section they talk about is investment objectives, time horizon, and risk tolerance. They talk about listing your short term financial goals and liquidity, your long term financial goals and retirement objectives, your time frame for these, the length of time you will need these assets, and the amount of assets required. So it's kind of a goal setting section. Then they have this interesting section, which I don't particularly have in mind, but they talk about the asset classes to use and those to avoid. Of course, I do have the ones to use, but I don't necessarily highlight what to avoid. So I thought that was interesting. They talk about asset classes that you must include in your overall investment portfolio. They talk about US stocks, international stocks, US bonds, for example. I have all of those in my investment policy statement. They also talk about asset classes you would rather avoid due to excessive risk, high expenses, or large tax liabilities, and so on. And they go on to list things like hedge funds, actively managed funds with high taxable turnover or distributions. Consider underweighting the tech sector due to my employment, for example. I guess if you're in a job that is in a specific sector, maybe you want to avoid overweighting that sector. Interesting. Never really thought of putting that in my investment policy statement, asset classes to avoid, but maybe that's a good way to ensure that you're not jumping on the flavor of the day, for example. A lot of people got very excited about AI, and maybe rightfully so. I don't know. Only time will tell. Some people jumped into that space because it was doing well. Now it's not doing well. Now, what do you do? So, this is a good place to identify what asset classes should you be using and potentially what asset classes should you be avoiding. Then they talk about asset allocation targets and rebalancing ranges, definitely something to have in your investment policy statement. They talk about the target allocation between stocks and bonds, the target allocation for international investments, any time frame for altering these allocations, the minimum and maximum deviations from these targets that will trigger portfolio rebalancing. And lastly, they talk about monitoring and controlling procedures. The frequency of monitoring, your benchmark for comparing your portfolio returns, an acceptable deviation from the benchmark. And I think that would be particularly important if you had an investment advisor, for example, a way to measure their performance if you are using an investment advisor. And then also any concrete procedures for future changes to your investment policy statement. For example, financial reasons for changing it, lifestyle reasons for changing it, and certainly any reasons not to change your investment policy statement. And that would include things like short term market performance, which we are experiencing today, potentially. I don't know if it's short term, but definitely market volatility is what we are experiencing today. And then they give you samples of what this might look like. I encourage you to go over to that link and check it out. Now, I want to talk about what my investment policy statement looks like, not in specifics, but in kind of the sections that I have in my investment policy statement. I have had one for many years and I've adjusted it as my timeline has changed, my objectives have changed, and it follows pretty much along with what the Bogleheads have outlined here. However, mine is a little, maybe more brief. It's a one-page document that outlines a few key points. In section one, I have my investment objective, which is for me, fund a long term retirement, hopefully around 30 years or more, within an acceptable risk tolerance framework while being mindful of risk capacity. What do I mean by that? Risk tolerance is how comfortable you are with taking risk. For example, accepting market volatility. And risk capacity is the maximum amount of risk a financial plan can tolerate and remain feasible or resilient without falling apart. So risk tolerance is kind of more the emotional side. Risk capacity is kind of the data side. How much can your plan accept without getting damaged? So the first is your investment objective and thinking about how much risk am I willing to accept and how much risk can my plan accept? And then the next section is portfolio allocation. Now, I feel comfortable with a higher risk tolerance, and my plan has a high risk capacity while remaining feasible and resilient. So I am comfortable personally with a higher equity allocation. This is something that each person individually needs to determine. This just happens to be what I am comfortable with. My personal equity allocation, I'm comfortable with somewhere in the neighborhood of 80% equities, even though I'm in the decumulation phase. That would be considered pretty high for most people in the decumulation phase. But like I said, I have a high risk tolerance and my plan has a high risk capacity. And the remaining 20% is in fixed income. Now, I prefer personally short term treasuries and cash for that. Many people will use bond funds, whether they are treasury bond funds or total bond market or what have you. I prefer, since I have such a high equity allocation, to use treasuries and cash as the offset. This is something that I've given a lot of thought to, and I have also experienced the associated volatility of such a portfolio with a high equity exposure in various bear markets over my decades of investing. I've been through the internet bubble in the late 90s, certainly the housing bubble in the 2008-9 period, and had very high equity allocation during that time. The portfolio obviously suffered significantly during that period. I was personally comfortable with it, so I have tested this allocation for my own risk tolerance level and am accepting of that volatility. This is something you shouldn't take lightly, especially if you haven't really experienced significant market declines over, I would say, a multi year bear market. Not necessarily that brief decline that if you missed a week or a quarter, you would not even have known that the market went down after COVID for a brief period of time, very sharp, but very brief. I'm talking about when you have a bear market over years, like the 2008-9 period, where it's just kind of this Chinese water torture of just drip, 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 down, down, down. That's when you really understand what your risk tolerance is. And until you have experienced this firsthand, you really won't know what your true risk tolerance is. And I see too many people say, "Oh, I'm comfortable with 100% equities," or something like that. And then a major bear market comes over many years, and then they realize that was too high for them. Now, many people who are accumulating during their very young years and have decades ahead of them, yeah, 100% allocation could be very reasonable as long as you don't deviate from that and get spooked out of it. So that was, for instance, my experience when I was in the accumulation phase. I was in the neighborhood of 100% equities almost all the time, accepted the volatility that came with it. I like the book, The Simple Path to Wealth. I will put a link to that. There are a number of chapters in there that talk about understanding market volatility and how it can be very challenging emotionally, that it will definitely happen during your long investment time horizon if you're young. And it's just part of the nature of the experience that you are going to have during your long investment timeline. Are we having one of those periods now? I have no idea. But I also identify the specific investment target percentages in this section for the individual holdings that will comprise the broad equity and fixed income segments. For example, in the 80% equities piece, there is total market. There's some international in there. I have a few other smaller investments that I also like to have in there personally. So this is the area where you can identify not only your total equity exposure, but how is that going to be divided up in equities and how is that going to be divided up in your fixed income section, for example. And then the last section I have is I kind of have it as one section in the Bogleheads. They have it in two separate sections, which is fine. It's the monitoring and rebalancing rules. Now, being the financial geek I am, I monitor my portfolio more than I probably should. That would be weekly. Every week on Saturday morning, I like to just update my spreadsheet across all of my accounts and all of my holdings and see what everything looks like. I'm not really doing anything with it other than monitoring it. I would say that quarterly would be more than sufficient. And that is what I actually have stated in my investment policy statement, that I should monitor this at least quarterly. And that's what I like to do. Now, some people will do it as infrequently as twice a year or even just annually. But mine is I state that I would like to monitor my portfolio at minimum on a quarterly basis. And that's the frequency that I have in my investment policy statement. Like I said, I do it more often, but I want to make sure I'm doing it at least quarterly for me. And then the last piece is rebalancing. There are Kind of two ways to rebalance, I would say. One is to just pick a point in time to do it. Some people will say, pick your birthday because it's easy to remember, or perhaps maybe you do it in January after year end statements are issued, or maybe you just pick another time of the year that's not right at the end of the year or right at the beginning of the year, but some other stated time. And a lot of people like to just say, birthday is an easy one. It's off the normal schedule where majority of people are rebalancing in December or January. Your birthday, unless it falls in January or December, is more likely to be an off period. So pick a date that you want to at least consider rebalancing. And another option is to rebalance if the percentages stray too far away from the target percentages. Some people will say, for example, if they move 10% away from the original target, I will rebalance even if it is not on my birthday, if that's your rebalancing date or January. And the reason for that is to just get the portfolio back in line with the original objective so it doesn't stray too far away from target. So, an example might be you have an allocation to 50% in some equity fund, for example, or fixed income fund, whatever kind of fund, 50% allocation. If it fell below 10% of that, which would be below 45%, or rose above 55%, you would rebalance. And then you would just bring everything back in line. Now, easier said than done if you have a taxable account because you have to think about capital gains and how that might affect things. However, if you have tax deferred accounts, it's easy to rebalance. You don't have to worry about long term versus short term capital gains, and you can just make changes without any tax ramifications. And you could also rebalance within your tax deferred accounts, for example, and then leave the taxable accounts alone and use the tax deferred accounts for rebalancing. So that is something else to be mindful of. And I actually have both of these options listed in my rebalancing rules. So I tell myself rebalance or at least monitor and check at your birthday. But if allocations get more than 10% away from their original targets, then rebalance. I find that frequently you don't have to rebalance that much. And I kind of let that tolerance move around. I don't worry about being exactly down to the 1% or 0.1%. I will let it fluctuate within a couple percentage points of the target without much worry, even if it's on the anniversary rebalancing date. So, when do you draw up an investment policy statement? The preference would be to do it when markets are calm and you can think unemotionally. However, if you don't already have one, that shouldn't stop you from creating one now. But just be aware that your emotions may be getting the better of you if you are someone who pays close attention to markets because they have certainly been volatile. Like I said, better to draw this up when those emotions are low, but that shouldn't prevent you from creating one if you don't have one. And then the last piece, and this probably should be in your investment policy statement as well, and it was mentioned in the Bogleheads article, when to revise your investment policy statement. Certainly not when emotions are running high. So if you're kind of freaking out because you're reading the news or you're seeing markets be more volatile, that's not a reason to revise your investment policy statement because those emotions may take over and not really allow you to use logic when creating your investment policy statement. So, you may want to tweak your investment policy statement if you find your initial risk tolerance assessment was incorrect, but you likely want to avoid rebalancing until the markets are calm and emotions have receded. You don't want to say, oh, I was way off and I'm just going to sell everything. You want to be logical when you revise your investment policy statement and remove emotion from the process. Then the other time to revise your investment policy statement is when your investment goals shift. For example, you're moving from an accumulation period, like when you're working, to a decumulation period when you retire, for example. You would certainly want to revise your investment policy statement. And if you have investment policy statements for certain goals, like saving for a house that might be decades down the road, but you get within, say, 5 years of buying that house, you would definitely want to revise the investment policy statement for that specific goal. That was a lot of information, relatively shorter episode. I'm going to try to keep these episodes relatively short. I have a few more that are going to come out. I had the privilege of recording a few episodes with Doug Cunnington at Mile High Fi. We recorded the other day. I will be releasing those shortly. And you'll hear a little bit about what I was up to in 2024. And also, we answered a listener question that was quite interesting. So look for those coming out. Well, I hope this episode was helpful and gives you an ability to tune out the current noise and volatility and stick to a solid long term plan for your financial success. Thank you for listening to this week's show. Please click follow on your favorite podcast player or subscribe on YouTube to ensure you don't miss any future episodes. Also, please leave a rating and review for the show. This helps improve the ranking and enables other like-minded people find the content in their podcast players. If you would like me to answer a question on the show, please send it to mark@marksmoneymind.com and put podcast question in the subject line. Let me know your first name, or let me know if you would like to remain anonymous, and also your state of residence if you choose. I would also appreciate it if you would recommend this show to friends and family that might benefit from this content. See you next time on the Mark's Money Mind Show. Until then, make some, save and invest, live on the rest. And now for the all-important disclaimer. This show is for education and entertainment purposes only and should not be considered investment, tax, or legal advice. Please consult the appropriate advisor or advisors before implementing anything you hear on this show or any other show for that matter. While I fully intend for everything on this show to be true and accurate at the time of each recording, occasionally errors may occur. So please do your own due diligence on anything discussed.